I think the issue that people have made a little bit too much of the Fed coming into the repo markets in the sense that there's this wonderful concept called Marshallian K when you're putting in supply side economics and particularly money supply growth that's faster than nominal GDP growth, that money goes into risk assets. It tends to work extraordinarily well if you're looking at areas like emerging markets. It tends to work less well when you look at the U.S. simply because there's a lot of receptacles for that extra cash. In other words, if it goes to risk assets, it could go to venture capital. It could go to private equity. It could go to the fixed income market and junk bonds or something. It could go to real estate development. It could go to new business formation. So it's not necessarily funneling into U.S. equities. I think it's a very common misperception that I can easily disprove with some math. But nonetheless, that is kind of a mindset.
Stephen, do you disagree? If we saw this balance sheet expansion stop, would that have an immediate effect on the equity market?
I do disagree. I'm sorry, Tobias. So the way I look at it is that when you had quantitative tightening and you had the Fed was tightening as well, that was a double whammy. So it was the equivalent of when you had QT, it was the equivalent of raising rates at every meeting, even if they skipped a meeting. So when you have QE, it's the equivalent of loosening, even when they're staying pat. So I do believe it has more of an effect. But I also, to pull in Sarah's thought process, when you look at around the world where interest rates are, that is a direct translation to why the risk assets of the S&P, when you're on a search for yield, people rush into this asset the first before they choose those other assets.